Good morning, everybody. Can you hear me at the back of the room? Put your hands up if you can hear me. Thanks very much. My name is Liz Huff, and I'm a councillor in the Township of Leeds and the Thousand Islands, and I'm a member of the AMO Board of Directors Rural Caucus, and I'll be your chair for this session, which is Asset Management, Why the Financial Stuff Matters. The municipal sector has done an impressive amount of work over the last 3 years on asset management plans. Municipalities are working to refine the plans and identify financing strategies. It is now time to put the asset management plan into action. For today's session, we have two speakers that were supposed to each speak for 30 minutes, but they're horse trading over here, so I think Bill will be a bit longer. And then we'll have some time for questions at the end. In the order they will present today, first up will be Bill Hughes. Bill Hughes is the Commissioner of Finance and Regional Treasurer for the Regional Municipality of York. He is responsible for managing the region's $3 billion combined operating and capital budget, the fourth largest amongst Ontario's municipalities. Bill is also responsible for the region's procurement and IT services. Bill held a number of senior roles in the Ontario government, mainly at the Ministry of Finance and the Ministry of Infrastructure. Prior to joining the region in 2011, he was the Assistant Deputy Minister of Infrastructure Policy and Planning. Bill has an MBA and a Master's of Environmental Studies from York University, as well as a BA from the University of Toronto. Bill also lectures at the U of T School of Public Policy and Governance, where he co-teaches a graduate course on policy development, and he is a member of the board of the Move Ontario Trust, which is a mechanism for financing public transit infrastructure expansion. Bill will talk today about the importance of the long-term view in asset management financing strategies. Our second speaker will be Kelly Rogers. Kelly is president of Rogers Investment Consulting and has over 30 years' experience in the investment and financial services industry. She has been a chartered financial analyst charter holder since 1989. In 1998, she was a founding member of the Investment Fund's Standards Committee and has held the position of chair. She remained a member of the committee until 2006. She has been a member of the Toronto Stock Exchange Issuer and Advisors Advisory Committee in 1994 and 95. In 2006, she was appointed for a 2-year term to the Investors Advisory Committee of the Ontario Securities Commission. In addition to being a founding member of the National Aboriginal Trust Officers Association in 2006, Ms. Rogers chaired the Advisory Committee from inception until 2011. Kelly Rogers' more than 30-year career in the financial services industry has included positions as registered representative and account executive with a national investment dealer, trust officer business development with National Trust Company, manager private client marketing with a bank, investment counsel, and portfolio manager positions at independent portfolio managers. Kelly will discuss why, in the absence of an investment plan, an asset management plan is simply a wish list. First, Bill.
So thank you very much, Liz. Am I catching the mic? Can you hear me at the back? Yes? Yes. Okay, good. So this is kind of like a church, eh? Like nobody wants to sit at the front. Thank you all for coming to this session. I hope that you're going to find it to be a good use of your time. I know you have lots to choose from, and so it seems like there is a lot of interest in asset management and the connection to financial stuff. I noticed also that in the address that President McNamara gave to the conference, that he said that based on the Municipal Next work that AMO has been doing, property tax increases of 8.35% per year for 10 years would be needed to maintain existing service levels, and close the $60 billion infrastructure gap. So that kind of puts a point on the timeliness of municipalities starting to think about asset management. So my topic is relatively straightforward. Safeguarding your municipality's future, financial sustainability and asset management. But like many things that politicians and civil servants do, this one is a lot harder than it looks. So I'll start with just a very quick introduction for why I'm here in the first place. So AMO asked York Region to carry out some fairly broad and comprehensive research on financial sustainability. And the purpose of this project is to examine the relationships among capital and reserves and debt and how those relationships affect financial sustainability and asset management. So it's pretty common in the municipal world to say that one size does not fit all. Regardless of what you're talking about, you've probably heard that, all of you around the municipal sector, you've probably heard that 100 times. And in the case of financial sustainability, one size may not fit all, but there also isn't a different size for everyone. And part of what we're trying to do is figure out what the key similarities and differences are among municipalities. And in other words, what matters to different kinds of municipalities in achieving financial sustainability. So what I'm doing today is just reporting on some of our initial thinking and research. There will be more to come in the future. And here's an overview of what I'm going to talk about. So I'm going to go through some principles, talk about geography and demographics, and you'll see why in a minute. That seems out of place, but you'll see why. And I'll talk about capital and asset management, about reserves, about debt, and about intergenerational equity, something that doesn't get as much attention as it probably deserves, and then a few take-home points. So let me start with a few thoughts about financial sustainability, what it really is and how to think about it. So on the left-hand side of this slide, what you are looking at is a picture of an ancient Roman aqueduct that is still in use today. It's called the Aqua Vergine. This aqueduct was built in 19 BC during the reign of the Roman Emperor Augustus and before Jesus was born. The man who built it was a guy named Marcus Agrippa, who was a prominent Roman general. As those of you who know your classical history will know that Agrippa was the guy who defeated Antony and Cleopatra at the Battle of Actium. And after he did all this general stuff, he became interested in public infrastructure and started building things around the empire, and this is one of the things that he built. It was renovated in 1453 by Pope Nicholas V during the Renaissance, and to this day, it brings pure drinking water to various places in Rome, including the Trevi Fountain, which is what you see on the right-hand side of this slide. So why start out with a picture of a really old aqueduct, a really old piece of infrastructure? The point I wanted to make to you was that the decisions that you make today about infrastructure and about asset management have long-term significance. They affect not only the quality of life of people today, but also the quality of life of future generations. So, like you tell your kids when you're talking about financial stuff, think long-term. Financial sustainability does require long-term planning. There is no two ways about that, and it doesn't just happen because you would like it to happen. The key to financial sustainability is taking the steps that you need to take now to manage both short and long-term risks. And it's mostly about two things: your service levels and your infrastructure. So before we go farther, I should talk a little bit about financial sustainability and the Public Sector Accounting Board. So if you've asked, for the politicians in the room, if you've asked your treasurers questions about financial sustainability, or if you have been answering questions that politicians have asked about financial sustainability, you have usually, or quite often, people default to the Public Sector Accounting Board position, and they have a statement of recommended practice which deals with financial sustainability, among other things, and you can see it on this slide. And they have a three-part framework, and they say that financial sustainability is the ability to manage existing programs and services without raising taxes or increasing debt. So in other words, keeping on going without new taxes or new debt. They talk about flexibility, which is if you need to raise taxes or increase debt, can you do that? And they talk about vulnerability, which is Can you cope with a change in the transfer payments from higher levels of government? So that's a nice conceptual framework, and it's what people tend to respond with when they are asked about sustainability and questions of that ilk. But although it's useful, it doesn't really tell you whether your municipality is financially sustainable or not. And so what I tried to do on this slide was to try and make financial sustainability a little bit more real for you. So this is how you can tell whether you are in a financially sustainable position or not. And I think most of you will find that you're probably not at this stage. So first of all, can you offer services that are comparable to other municipalities that are like you with a similar tax effort? That's part of financial sustainability. Can you adjust your service levels in response to changes in transfer payments? Often what happens for municipalities is they find it very difficult to change service levels that are long established if transfer payments change. Can you keep your infrastructure in a good state of repair? Do you have enough reserves or debt capacity to replace your infrastructure at the appropriate time? And can you adjust your capital plan in response to changes in the rate of growth? Those are more on-the-ground indicators of what financial sustainability is really about. It's pretty hard, actually, to get to a financially sustainable position, and here are some of the challenges. First of all, the cost of infrastructure investments, and that's partly what we're talking about today with asset management. Asset management is not just a nice phrase, it is a very expensive phrase. Another problem that many municipalities are facing or will face is a mismatch between level of service decisions and fiscal capacity. Unforeseen revenues or spending shocks can affect municipalities. Growth might not materialize as quickly as expected or at all, and that can strand your infrastructure investments or your debt. And water and wastewater rates might be at less than full cost recovery. So all those things are challenges around financial sustainability. But for this presentation, a key point is you can't have sustainability without good asset management. All municipalities have infrastructure. If you're not good at asset management, you're not going to be financially sustainable, regardless of what else you do. These are some of the factors that link asset management and financial sustainability. So, and some of this you may have heard before in other contexts, but what kind of infrastructure are you responsible for? And I'll say more about that in a minute. How much infrastructure do you have on a per capita basis? How much do you need to invest and when? And what is your ability to generate money to make that investment? And what are our obligations to future generations? So now I'm going to show you a couple of slides that will repeat later in the presentation with data points attached to them. But right now I'm just showing you a conceptual framework. On the left-hand side of this chart, so the vertical axis, we have fiscal capacity, which is just measured as weighted assessment per capita. And moving up means higher fiscal capacity. Along the bottom of the chart, we have infrastructure intensity, which is measured as the value of your infrastructure on a per capita basis. And as you move right, infrastructure per capita increases. So infrastructure intensity can vary for a bunch of reasons, including simple geography. So for example, a municipality that has 10,000 people in it might have 2 bridges, or it might have 15, just depending on how many rivers and swamps there are in the municipality and where the roads need to be. So infrastructure intensity is not just a product of municipal political decisions, it's also a product of geography. The chart's divided into 4 quadrants, and starting with the top left, which is labeled the fortunate few. So these are municipalities that have strong fiscal capacity and low to moderate infrastructure intensity. If you're one of these, you're in a good position, but not many of you are one of those, as you'll see later. On the other hand, you might be in the bottom right quadrant, which is labeled the unfortunate zone. And if you are unlucky enough to be here, you have relatively low fiscal capacity, but you have high infrastructure intensity, and you are likely already having trouble. The other 2 quadrants, bottom left and top right, are labeled fiscal strategy as critical. And that just means that you are in a pretty good place along one of the dimensions, but not both. So you either have good fiscal capacity, but high infrastructure intensity, or you have low infrastructure intensity, but also low fiscal capacity. And in both these situations, and maybe others as well, your fiscal strategy is a critical determinant of whether you can be financially sustainable or not. And I'll say more about fiscal strategy in a second. And here is a similar looking chart, but with different axes. So on the vertical axis, we have investment needs. And this is just how much you need to invest in your infrastructure, which is clearly related to infrastructure intensity, but also to the age and condition of your infrastructure. And farther up the axis means higher investment needs. Along the bottom of the graph, we have investment urgency, which means how soon you need to make your investments. The sooner you have to make them, the more challenging they are, and the less time you have to save. So again, we have 4 quadrants, and starting with the top left, labeled potentially unmanageable, this is where you do not want to be. But some of you may be there already, whether you want to be there or not. It means you have high investment needs that should happen sooner rather than later. In the bottom right, you have moderate investment needs and you have plenty of time. So you're likely able to cope just using your normal budgeting process. In the remaining 2 quadrants, bottom left and top right, you either have moderate needs that are fairly urgent, or you have high needs but some time before they materialize. And in both cases, the quality of your fiscal strategy is critical to your success. Okay, so that's a little bit of a conceptual framework that we'll use a few times. So what is a fiscal strategy? So you can call it anything you want. You can call it a fiscal plan. You can call it a long-term financial plan. It doesn't really matter what you call it. The name's not important. I've called it fiscal strategy for this presentation. That's what I call it with my own counsel. But whatever name you happen to give it is fine. The key thing about a fiscal strategy is it's about relationships. It's about the relationships between the key elements of your financial plan. So anyone can have a capital plan or a reserve management plan or a debt management plan, and everyone has to have a budget. But the idea of a fiscal strategy is to figure out the best and most advantageous relationships among these things, and to organize those relationships so that you can achieve financial sustainability. All right, now that's a little bit of a conceptual framework for how to think about financial sustainability. Now let me turn to municipal context and geography and demographics. And the reason for this is we think in the course of this research that financial sustainability and fiscal strategy look different and present different kinds of challenges in different kinds of municipalities. And that's partly what the project is about. So if we don't understand the municipal context properly, then our hypothesis is we will never be able to understand why different municipalities behave differently. So this is a complicated looking chart, and I'm not going to take you through it. The essence of it, though, is there's 444 municipalities in Ontario, and they are pretty diverse. Approximately 39% of them are single tiers. Only 7% are upper tiers, which means regions, counties, and there's also one district. And over half are lower tiers within upper tiers. The vast majority of those are lower tiers within counties. So I won't take you through all the details, but they're there if you're interested. The big point is there's lots of different kinds of municipalities with different relationships with each other. And all these different kinds of municipalities have different responsibilities for different kinds of infrastructures. So single tiers, of course, are responsible for all their infrastructure. And a number of the single tiers we have in Ontario used to be 2 tiers. So think about Toronto, Ottawa, and Hamilton. Counties have relatively limited but important infrastructure responsibilities, including major roads and waste disposal. Regions were initially created in the 1970s to provide hard services such as major roads and water and wastewater. And they were intended to obtain economies of scale from providing those services over a larger geography, and thereby to enable future population growth. So they have lots of infrastructure and they're building more all the time. So you can see, without looking at the entrails of this chart, there are lots and lots of differences in the infrastructure responsibilities that municipalities have, and that has implications for asset management and financial sustainability. So a few demographic slides. So the way to read this is the numbers on the pie. For each slice of the pie, the top number is the population range, the middle number is the number of municipalities that are in that range, and the bottom number is the percentage of municipalities in that range. So the striking thing here is that almost 2/3 of municipalities in Ontario have a population below 10,000. So that's the big brown and blue slices of the pie. 2/3 have a population below 10,000. So we tend to focus on lots of big municipalities that make the newspapers and so on, but 2/3 are 10,000 or fewer people. But the population is very concentrated in large urban areas. So the way to remember some of the nomenclature on this slide is census metropolitan areas and census agglomerations. Those are the terms that are used here. And over 80% of the population lives in one of a few large urban areas, which are called census metropolitan areas. And you can see the list of census metropolitan areas on the right-hand side. So there's not very many of them, but 80% of the population lives in those areas. And the way to remember what they are is they're just groups of municipalities that form a common labor market. A census metropolitan area has at least 100,000 people in it, and a census agglomeration has at least 10,000 in it. StatsCan uses this form of organization quite a lot. Before we move on, I just want to talk a little bit about forecasts of population growth, and you'll see why in a second. Growth actually turns out to be fairly important when you're talking about financial sustainability and asset management. So I have a few slides that show you growth projections for different parts of Ontario over the next 20 years or so. So green means slow growth, orange and brown mean fast growth. So growth is expected to be slow or negative in Northern Ontario, probably not too surprising to the folks from Northern Ontario. This is Southern Ontario. Growth rates are more mixed, with fast growth in Central Ontario and slow growth in Eastern and Southwestern Ontario. Here's the Greater Toronto Area. Every municipality except Durham is expected to grow by more than 30% by 2031. So shows you the really big differences between the different parts of the province. And if you think about it for a second, and you think about Toronto a little bit, you'll realize there's something really remarkable about this map. And that is the unexpected and surprisingly rapid growth in the City of Toronto. So these are pretty up-to-date projections from the Ministry of Finance. And what's happening is that Toronto is receiving growth that was expected to go to the 905 regions. So the question then, so I'll just take a minute to talk about that. So the question then is why? Like, why is Toronto all of a sudden seeing growth at the expense of the 905s? So this chart shows you net intra-provincial migration. So what that is people moving around within the province. So it sums to zero. It's just people moving around from one municipality to another municipality. And it shows you intra-provincial migration over the last 15 years. So the blue line on this chart is Toronto, and the red line is the 905 regions. And in the early 2000s, Toronto was losing about 80,000 people to the rest of Ontario every year. 80,000 people every year lost. But in the last few years, that has decreased dramatically. Toronto is now only losing about 20,000 people a year to the rest of Ontario, a quite significant turnaround. And the 905 regions around Toronto, so the red line, have gone from gaining 50 to 60,000 people per year from the rest of Ontario down to a gain of less than 10,000 people a year. So it isn't hard to figure out that what's happening is that migration from Toronto to the 905 regions has slowed substantially. So people used to have kids move out to the 905, does not seem to be happening as much or as quickly. And this slide helps to explain why. So I won't do both sides. You can look at it later if you're interested. But again, the way this works is blue lines are Toronto and red lines are 905. And this is just about what the young adults are doing. So not the baby boom generation. This is the 25 to 44-year-olds. What are they doing? And the graph on the left shows net migration, which is all different kinds of migration. International migration, interprovincial migration, migration within the province, ins and outs. It's the whole thing. And the graph on the right only shows migration within the province. I won't spend time on the right, but focus on the left. And you can see in the graph on the left that Toronto has gone from a net annual loss of almost 10,000 25 to 44-year-olds in the early 2000s to a gain of almost 10,000 in recent years. And the 905 regions have gone from a gain of close to 50,000 to only about 15,000, a really big decline. So what this is telling us is that, much to everyone's surprise, people in the 25 to 44-year-old age group are choosing to buy condos in Toronto and avoid the long commute out to the 905. Whether they'll continue to do that, who knows, but that's what they've been doing over the last few years. So what does all this mean for financial sustainability? And I'm going to talk about that in most of the rest of the presentation. So first, let's look at fiscal capacity. So remember, this is your ability to raise money to pay for things. So what we found, so this graph shows you fiscal capacity against population. And what we found so far is that fiscal capacity doesn't seem to vary much with population size. Or another way of looking at that is that fiscal capacity can vary quite a bit between similarly sized municipalities, and that's probably the better way to look at it. Fiscal capacity can vary quite a lot between municipalities that are the same size. But one thing for sure is that if you're growing, you have better fiscal capacity than other people. Even if you're growing at very modest rates, so even if you're just slightly to the right of the red line, you're probably going to you're definitely going to have more fiscal capacity than if you are not growing. And if you're not growing, so if you're on the left of the line, you're going to find achieving financial sustainability a really big challenge. And that's about 40% of all the municipalities in Ontario. 40% are on the left of that red line. So now let me turn to capital and asset management. So some of you may have been wondering why municipalities have suddenly become so concerned with asset management. And it's actually not, sorry to say, because today's municipal politicians and civil servants are a whole lot smarter than the people who came before. It's because asset management has become a huge challenge to financial sustainability. And this table tells you why. 50 years ago, local governments were responsible for a little over 1/3 of infrastructure. Now, that number has grown to more than 2/3. So municipalities have assets that are getting older, and they have much more responsibility for them than in the past. So that's if you were looking at one slide that explains why there is all this interest in asset management in the last few years, this is why. Municipalities own a much, much bigger, probably, I guess, close to twice the share of infrastructure that they did 50 years ago, and that's a really huge change. So this is a diagram, the like of which you've probably seen, 100 times before. But the main point here is that asset management has become critical to financial sustainability. So the left-hand side of this, I won't take you through the whole thing, but the left-hand side of the slide shows you the 3 things that you need to think about in an asset management plan. And there's really only 3 things you need to think about for an asset management plan. The first is the level of service that you want from your assets. The second is what investments you're going to need to make in the asset over its life. And the third is how you're going to pay for them. And that's it. That's what an asset management plan is about. So good asset management is simply managing an asset so that it provides the level of service that you want from it over its life at the lowest possible cost. That's what you're trying to do with good asset management. And this is a simplified version of why it matters. So this particular example is a road. The blue line is bad asset management. The green line is good asset management. So the blue line, bad asset management, you just let the road deteriorate until you need to reconstruct it. And using that approach, you reconstruct it twice in 50 years at a cost of about $100 million. The green line represents good asset management. You resurface the road every 16 to 17 years, and then you reconstruct it at 50 years. And if you spend a minute looking at these lines, what you would see is that the good approach to asset management results in lower costs, and it also, on average, gives you a road that's in better condition over its lifespan. But you have to have the money to make the asset management investments at the right time. Ontario municipalities have about $200 billion in capital assets right now, and about 1/3 are water and wastewater assets, and another 1/3 are roads. So the asset management story is very much about water, wastewater, and transportation. And the good news is that generally speaking, municipal infrastructure is in reasonable condition. Most asset classes, as you can see from this graph, have 60 to 70% of their useful life remaining. So that sounds great, but there is a little bit of a data issue. So this graph might not reflect your situation. You might not be feeling like all your assets have 60 to 70% of their useful life remaining. And this data is skewed by the large investments that the growing municipalities, like the regions, for example, have been making in infrastructure. And many smaller municipalities that are not growing may have older assets. And also some assets that are fully depreciated are not part of this. So this is a good story, but it might be slightly optimistic. So right now, so we have about $200 billion in capital assets, and we're investing about $10 billion a year in capital assets. So that's the blue line. But although we're investing $10 billion a year, that capital is depreciating at the rate of about $4.3 billion a year. So it would be really interesting to know what portion of our $10 billion in investment is for new infrastructure and what portion is for state of good repair. Unfortunately, we don't know that yet. We are trying to get data. We think, though, that the amount that's being invested in rehabilitation and replacement is significantly below the $4.3 billion in amortization. And if that's true, it means that the stock of infrastructure that we have in the municipal world is deteriorating. And that accounts for things like like President McNamara saying there's a $60 billion infrastructure gap. So this slide shows you that infrastructure intensity, so infrastructure intensity, you might remember, measured as capital assets per capita, it generally declines with population size. So bigger municipalities don't have as much infrastructure per capita. There's a spike up in the 250 to 500,000 population range, and we think that might be due to the introduction of transit systems in that size class. Once you get that big, you start to have transit systems, and then you need more capital to deliver that service. So now I'm going to show you a few slides that use the conceptual framework from earlier in the presentation. And the next few charts plot fiscal capacity against infrastructure intensity for different kinds of municipalities. So every dot on these charts is a municipality. And this slide just looks at municipalities in urban areas. So municipalities that are in census metropolitan areas or municipalities that are in census agglomerations. So we're capturing both urban municipalities and the rural municipalities that are part of an integrated labor market with those urban municipalities. And so this reinforces the point that I made earlier that fiscal strategy is critical for most of these municipalities. You can see lots in the lower right and upper right quadrants. So this is the same graph, fiscal capacity against infrastructure intensity, but this is for small municipalities. This is for municipalities under 10,000. And they're mostly rural and northern municipalities. No surprise there. There's 225 of these municipalities, and they tend to have lower fiscal capacity, but they have hugely varying levels of infrastructure intensity. Remember, some might have 2 bridges, some might have 15, some might have 50. Big variations in infrastructure intensity. And so what that means is that financial sustainability is going to be a lot easier for some of them to achieve than for others. So this is the same chart for counties. And counties tend to have lower fiscal capacity and low infrastructure intensity. Except you can see there's one outlier in that top left corner in the fortunate few. Most are in the bottom left quadrant. There is one lucky municipality up there in the top left quadrant. And in this presentation, I'm not normally naming the municipalities, but if anybody's here from Haliburton, congratulations. Haliburton is the one that is up there in the top left. So this is the second of the 2 conceptual framework charts I showed you. So this plots infrastructure intensity against investment urgency. And the good news, so this is municipalities in urban areas, and the good news for municipalities that are in urban areas is most of them have some time to address their infrastructure issues. And they're going to need that time, but they do have some time. So that's good for municipalities that are in urban areas. This is investment needs in small and rural municipalities against infrastructure intensity. So compared to their urban friends, their need to invest is much more urgent, regardless of the amount of infrastructure they happen to have. Now let's talk about budgeting for asset management. So the National Research Council says 2% of your assets should be spent on repairs and normal kinds of rehabilitation, and another 2% should be contributed to reserves each year. So the asset management money you can see labeled on the chart. It's just the amount that you spend on pay-as-you-go capital plus the savings that you contribute to capital reserves. And then you draw from the capital reserves to make your major life cycle rehabilitation investments, asset replacement, and growth capital not covered by development charges. Or you issue debt and pay it back over time, one of those two. So a quick side note, there's a lot of discussion right now about development charges, particularly for municipalities that are growing. The province has reforms underway. Regardless of what happens with the province's reform package, growth will still not pay for growth. So what that means is some capital money that would otherwise be spent on asset management has to be diverted to pay for the portion of growth capital that is not covered by development charges. Half of municipal capital spending is financed either through draws on reserves or debt. So no big surprise there, but large and small municipalities behave fairly differently. Large municipalities rely more on reserves and development charges, and small municipalities rely relatively more on transfer payments and debt. So the reliance on debt by small municipalities is not what we expected. So now let me talk about reserves a little bit. So most municipalities have saved less than $1,000 per person to meet their infrastructure needs. Less than $1,000 per person in reserves. And surprisingly, even though small municipalities use reserves less than large municipalities, they have the most saved on a per capita basis. And this may in part reflect the aversion that small municipalities have to debt and possibly less ability to issue debt. So the quality of your reserve management strategy is a key factor in determining whether you can achieve financial sustainability. It's part of your fiscal strategy along with your long-term capital plan and your debt management plan. So what you ultimately need to be able to do is to save for your capital asset life cycle and replacement investments. And you need to find the right mix between reserves and debt. So this shows you reserves per capita against infrastructure intensity for municipalities in urban areas. And you can see that reserves per capita tend to rise with infrastructure intensity. So the more infrastructure you have, the more you tend to save if you're in an urban area. So that's pretty much what you would expect. But you can also see a lot of variation, and there's a fair number of municipalities with moderate to high infrastructure intensity but low reserves per capita. So those guys are in trouble. So I'm getting a 5-minute warning here. Okay. So it's a different story, though, with small municipalities. So they're all over the place, and there's very little correlation between reserves and infrastructure per capita, which suggests that quite a few of them are in trouble with respect to their future asset management needs. So the question is, how much should you be saving? And the answer is, it's hard to say. It depends on your investment needs and the timing that you identify in your asset management plan. It depends on the preferences you have with respect to pay-as-you-go capital versus funding from reserves, and the trade-off that you want to make between reserves and debt. So now let me just talk briefly about debt. I'm going to have to go a little bit faster here. So debt's a big issue, hotly debated. So people who like debt say that it spreads the cost of assets over a longer portion of their useful lives. People who don't like debt say that debt servicing payments reduce fiscal room and crowd out other spending. Ontario municipalities owe about $17.6 billion, and 87% of that is single and upper tier municipalities. And just to give you a kind of a frame of reference, the province's debt management plan calls for $35 billion in new debt this year. So province is going to issue twice what municipalities hold just this year. Small municipalities generally have little to no debt. Oh, am I? Sorry. Yeah, thanks. Small municipalities generally have little to no debt. So there's 109 municipalities under 50,000 people, and they have less than 10% of the total municipal debt. And the big three have almost half of all the municipal debt. More than 3/4 of the debt is for water, wastewater, transportation, and surprisingly, social housing. 13% of the debt is for social housing. Generally, municipalities have between $600 and $800 of debt per person. It's probably a little higher for those who actually hold debt because there's a lot who don't. And again, back to these same kind of slides, debt per capita tends to rise with infrastructure intensity in urban areas. So not a huge surprise. And this shows you debt per capita for large municipalities. So not just urban areas, but just the big municipalities. The blue dots are the 5 biggest single-tier municipalities. The red dots are the upper-tier regions. So you can ignore the green dots for now. And what this is saying is that large municipalities with heavy infrastructure responsibilities tend to issue more debt per capita. Small municipalities are a different kettle of fish. They are much less willing to take on debt regardless of their infrastructure intensity. And I think there are good reasons for this. For example, they might realize they can't afford the carrying cost of debt, and they therefore have to let their infrastructure deteriorate until the next grant program comes along from the federal or provincial governments. So let's see, intergenerational equity. So this is something you need to think about, because good planning means the generation of people who benefit from an asset is also the generation that pays for it. And there are quite a few studies right now that suggest that the children of baby boomers will be the first to have lower lifetime income than their parents. And that may suggest that we should be saving more now than we had previously expected. So this chart's a long time series, all the way back to 1976, that shows you real income per capita. And these are annual increases after inflation. So I won't do all the different lines, but essentially what this chart is saying is that the younger generations have experienced either no increase in income or declines in income, whereas the older generations, the baby boomers, are doing quite nicely, thank you. And so what's the result? Well, one result is that family formation is being delayed. And what this chart shows you is that in the space of a little over a decade, there has been a huge change in fertility rates. So fertility rates for women in their 20s have gone down. Fertility rates for women in their 30s have gone up. And that's an impact, we think, of the difficulty that young people are having in establishing themselves in today's economy. This slide is about an intergenerational equity issue. So this is water and wastewater cost recovery. Walkerton happened about 15 years ago, and you may remember that some people died as a result of the Walkerton tragedy. And you would think that that would have galvanized everybody into huge investment in their water systems, and to some extent it has. But when you look at the question of whether municipalities have achieved full cost recovery for their water and wastewater systems, over 70% have not. Now, if you ask most people in municipalities, they say, oh yes, I'm at full cost recovery, but the facts are otherwise. All right, so a few take-home points, and then I'll stop and let Kelly talk. So, financial sustainability is about the stewardship of the long term. And asset management is simultaneously a big challenge for financial sustainability and also essential for achieving financial sustainability. If you do want to be financially sustainable, you need to start planning now. Fiscal capacity and infrastructure intensity have a major impact on how easy or how difficult it is to achieve financial sustainability. Growth is going to be concentrated in a small number of municipalities, which creates financial sustainability challenges for many of the rest. We already talked about growth not paying for growth. Relatively few municipalities have saved enough in reserves to meet their future asset management needs. Relatively few. Many small and rural municipalities have no debt because they know they can't afford the carrying costs, even though they need to invest more in their infrastructure. So a lot of those folks are caught. Municipalities that can't afford to save or issue debt are forced to wait for infrastructure grant programs and hope that they're enough. Tax and rate increases at or below the rate of inflation, which is kind of a mantra in the municipal sector these days, may be shifting the burden of asset management investments to future generations. If you're trying to keep your tax and rate increases below inflation, you are probably not investing enough in asset management. To achieve financial sustainability, most municipalities will need a fiscal strategy that articulates the relationships between their capital plan, their reserve management plan, and their debt management plan. So my last point here is the nature of fiscal strategy that a municipality should pursue is contingent on its own situation. What we're trying to do is derive general principles, but it depends a lot on where you fit in the larger scheme of municipalities. So I've taken more time than I should. Thank you very much for your attention. I'm going to pass it on to Kelly.
Good morning, everyone. For those who are standing at the back, there's lots of chairs up front. So while they figure out the technology to get the presentation up, I was at a presentation many, many years ago, and it was a bank economist, Sherry Cooper Anderson, not sure what name she goes by now. And they told her, well, you know, we've had to make some changes to the agenda. You actually have less time. Her response was, okay, I'll just talk really, really fast. My presentation is actually quite short, so that shouldn't be a problem. So asset management plans are challenging. Hey, so are investments. As Bill has pointed out, there's a number of factors that go into your asset management plan. I'm really just going to talk about the reserve side of it, the savings side. You have competing short-term and long-term needs. I'm betting if I ask for a show of hands, who's got more money than they need? What? No hands going up? Yeah, you know, the needs are always going to be greater than the available resources. You've got a desire to avoid unpleasant events. Whether that is a major break in a sewer line or frozen pipes. Well, in the investment world, we don't like it when things go down. That's our negative event. That's our unpleasant event, negative returns. I'm guessing most of you actually have a distaste for tax increases. But many, as Bill pointed out, also have a distaste for deficit financing. But we also have a distaste for volatility in our earnings, not knowing what our earnings are going to be from our reserve funds each year. So I look at it and say, and I think, you know, without an investment plan for your reserves, then you don't have an asset management plan. You have a wish list. Well, these are all the things we'd like to do. Well, how are you going to pay for it? Lots of things I'd like to do, and then I look at my bank account and think, well, okay, maybe I better change some of my wish list. The investment plan determines how you pay for the wish list. Is it through tax increases? Is it through earning interest income on deposits? Is it through earning interest dividends and capital appreciation from marketable securities? Or as Bill pointed out, is it by issuing debt and then we'll just pay the debt service and somebody else has to worry about it down the road? Which really comes back to the whole intergenerational equity concept that Bill addressed for us. And, you know, frankly, as one of those baby boomers, I'm going to say, hey, it's in my self-interest to say, I don't want to pay for roads that are going to, or a bridge that's going to last 50 years. I'm going to be dead in 50 years. Why should I pay for something I'm not using? That's a challenge, and that's a challenge way beyond the investment area. So you have competing interests. The desire to spend now on infrastructure, the desire versus the desire to invest now and have those funds for future spending. And there are pros and cons to each. Spend now, clear up your backlog. Appeal to voters, that's important. And hell, we'll all be retired in 15 years and we won't have to worry about the problems we leave behind. The cons are it just creates a bigger bill down the road, and which will result in bigger tax increases. The invest now to generate those savings. The pros are you can use the investment returns to mitigate future tax increases, and you use today's tax dollars to prepare for future replacement. The cons are that it reduces the funds available now for critical needs. And just like on the previous example, we're all going to be retired in 15 years. Well, we're going to be retired in 15 years, and nobody's going to be patting us on the back going, boy, were you ever smart 15 years ago. So I did a little scouting around the OMERS website yesterday. Anybody heard of OMERS? Oh, just a few. Okay, good. Well, OMERS is a great example of what actual long-term investing can do. In 2014, according to their annual report, they took in $3.7 billion in contributions. In 2014, they paid out $3.1 billion in benefits. In 2014, they earned $6.5 billion in investment returns. It's those investment returns that are going to take the OMERS from about, I believe it's about 89% funded today, to their target of 110% funded. It's those investment returns that are going to provide for incremental and increasing benefits to plan members down the road. $6.5 billion is a lot of money. Certainly more than I have. So can investment returns really make a difference, though? Yes, they can. And I would suggest this is as close to free money as you are ever going to get. The cost of that free money is volatility tolerance. You have to be able to ride it through. So I'm going to have to look at the numbers to read these screens because I didn't bring a magnifying glass. These charts are assuming a $1 million initial investment and initial investments of $1 million each year, and that investment is made at the end of the year. So at a 2% return at the end of 20 years, you would have $25.7 million. At a 4% return, you'd have $31.9 million. And at a 6% return, $39.9 million. How many would prefer to have $40 million instead of $25 million? Any takers? Yeah, we got a couple of people who said, yeah, 49 is better than 25. So the investment returns can actually make a big difference. So in this chart, the blue bar is the original capital contributions. The red bar is the investment earnings. So again, in the 2% return, we see that, oh, okay, well, we put 20 million in. So our investment returns were only 4.7 million. And, you know, over 20 years, that's really not very good. But at the 6% return, we put 20 million in, and our investment earnings were 18.9 million. And if we'd taken this out to 25 years at 6%, you would have seen that the investment returns would have been probably greater than the actual capital contributions. So over the long term, equities outperform bonds. Bonds don't do well when interest rates rise. How many people are expecting interest rates to rise? sometime in the next few years. I know we've been saying this for 5 years, but it will eventually happen. When interest rates go up, bond prices go down. Corporate bonds, however, provide additional yields, additional returns over government bonds. And I would argue that those earnings rates of 2%, 4%, and 6% are entirely realistic. So these I've updated to June 30th. So this gives you all the various types of returns. You could have put your money in a 5-year GIC. Well, in over the last 20 years, you would have earned 3.3%. Would have had no volatility, but that's not going to pay for a lot of infrastructure, I don't think. If you put them in short-term bonds, 1 to 5 years maturity, over the 20-year period, 5.3%. So you got a 2% pickup in return, and yes, you did have to suffer a little bit of volatility. Midterm bonds, those with 7 to 10 years of maturity, on the same 20-year period, 7.4%. Well, that's way better. Now remember, this is a period of declining interest rates. We're not going to see those numbers come from bonds again. The next 20 years, I don't think we're going to see 7% returns on bonds. But in Canadian equity, your returns over 20 years would have been 9.2. Even your returns over 15 years would have still been 6.5. Yes, a lot more volatility, but a lot more return. That 15-year, key in on that number. That included the tech wreck. That included the financial crisis. 2 of the 4 worst market environments in the last 120 years. And yet, the world didn't end. Equity still made money. And over the 20 years, they made more than the fixed income. So how do you figure out what your asset mix is going to be for your long-term investment plan that is part of your fiscal strategy for your asset management plan? I mean, this is an example of a very simplistic, Bill, please don't laugh at how simplistic it is. I'm sure yours is way more sophisticated. But when are you going to have to replace those assets? What's my time horizon? If the bridge just went in today and it's got a 50-year lifespan, well, my reserves for that bridge should be 100% equity. If I've got road maintenance in 3 years, that should be 100% fixed income and short-term fixed income. So you have to look at what your actual replacement needs are going to be. And in this hypothetical example, and you know what, I know nothing about infrastructure replacement, so feel free to laugh at my time horizons here. You know, water treatment, 7 years, I'm just making these up. But it just shows a very simplistic way of working through it. Now, in this case, just based on these time horizons, it says that about 50% should be allocated to equities. First of all, how many municipalities in the room have investments in the one equity fund? Okay, less than half a dozen. Does any of those half a dozen have an equity allocation of their reserve funds even approaching 30%? Yeah, that would be 0. So to those of you that do not have allocations to equity through the one equity fund, you are leaving a lot of money on the table. The same with the corporate bond fund. You are leaving a lot of money on the table. So some of the other considerations we have to look at, though, is interest rates are at historic low levels. Might have been one thing 20 years ago to say, we're just going to stick it in GICs. Sure, you could get 15% on a GIC. Not anymore. Yes, it may make sense to borrow, use leverage for some of those longer-term investments, and Bill addressed that quite thoroughly. But also accelerating infrastructure investments may bring both financial and non-financial benefits. It may increase your ability to attract business and industry, and it may provide a better quality of life. I'm struck by one of Bill's charts with the red line up the middle. The guys who aren't growing are going to have some real problems with their infrastructure replacement. If you are growing, even at a very modest rate of 1%, you're going to be in much better shape. So having decent infrastructure is probably part of the growth strategy. You know, when I'm ready to leave Toronto, am I going to go, oh, let me see, I want to find the municipality that's got the worst infrastructure in the province, and that's where I want to move, because their tax rates are going to go up, so I'll have that to look forward to. No, I'm going to look at, okay, London, Kitchener, Welland, St. Catharines, Barrie, you know. I don't want to be too far from, you know, the airport, but which of those places are going to be the nicest places to live for the next 15, 20 years? So my recommendations are to match your investment time horizon to your spending time horizon. Use investment returns to create additional funds. The cost of volatility is worth it. So yeah, you're going to have a few sleepless nights. Yes, you're going to have a few very stressful meetings when markets are down. Because they only ever come after you when markets are down. They don't say, boy, were you ever smart to be invested when the markets were up 15% last year. No, 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 no. Everybody knows that. But prudent stewardship is a long-term approach. That's a bit about me, and that's all I have. So did we make it in time?
Doing really well.
Okay.
Thanks. Well, we have some time. We have some time for questions. I'd appreciate it if people would come to the microphone, so because we're recording the session and others will want to hear the question. While people are coming up to the microphone, I just want to make one comment about each of the presentations. Bill's slide about intergenerational equity is interesting to me because not only are younger people's incomes not growing like my generation, but there's also a lot fewer of them. And I think it sort of strikes me what a big moral responsibility we have as elected officials to think about the long-term horizon, more so even than our forebears did. And just for those who might not recognize the term, Kelly asked you about the One Equity Fund. That's an LAS program. That's the business arm of AMO, something that AMO has worked on creating for you, recognizing this serious issue. So could you please state where you're from and go ahead and ask your question. Bill and Kelly, you can stay at this microphone.
I'm from Huntsville, in Muskoka, and my question is very simple. I'm wondering if I can get a copy of your presentation, Bill.
Can I just talk into this? Is that all right?
Yep.
Yeah. So I think the answer to that is yes. I think AMO is going to make the presentations available afterwards, but certainly if you have any problem, I'm happy to provide copies to anybody who wants.
Thanks very much.
Just so I can clarify for people, Judy, is there going to be a dedicated area on the AMO website? Post-conference materials, all of the presentations pretty well will be available to people. Next question.
Hi, my name's James Duke. I'm Deputy Mayor of Bradford-Scomburi. Thank you both for the presentations. Thought they were great. My question, though, is we're one of the lucky ones. We're in the growth part of that graph. We're on the other side of the red line. And but my biggest issue here is it was great to hear all this stuff, but growth is not being paid by 100%. So is there a study or something going on about how are we going to get to that where DCs actually pay 100% of growth? Is there something out there, like what is the impact to the economy? What is the impact to Ontario itself, I guess, in general? So when is growth going to pay 100%? Is there something out there, Bill, that people are studying that to see if we can get the 100% paid for DC charges?
Is it all right if I answer that? Okay, I'll do my best on that one. So the province has recently, in the past few months, released Bill 76, which does make some improvements in our ability to collect a greater portion of the cost of growth. if the bill is enacted. It's a little bit unclear exactly how it's going to work because the province didn't release any of the details associated with the regulations to implement the proposed legislation when they tabled it. There are various working groups, and I know AMO is participating in the working groups to try and get regulations that are as helpful as possible. My own assessment is that even if Bill 76 lands in the best possible place, growth will still not pay for 100% of the cost of growth through development charges. There will be still some amount of cross-subsidization from either the tax base or the rate base or both for growth. And that's something that, as I said earlier, is likely to cannibalize the money that you have for asset management. But I think all of us in the municipal world, we have to play the cards we're dealt, and I think for the foreseeable future, we're going to have to accept the fact that we're not going to be able to recover all of the capital costs of growth from development charges.
Next.
Hello, my name is Amy England. I'm a regional and city council member from Oshawa, and I just wanted to touch on the intergenerational inequality. How do we start having these conversations at the local level when everyone talks about freezing taxes and keeping taxes below inflation, and the responsibility to the current taxpayer who just voted you in versus the responsibility to my generation and future generations who don't have the same opportunities that the current citizens who voted us in had when they were our age. So I'm just wondering, how do we broach that in a more serious way at our local municipalities to really talk about the injustice and the inequality that's occurring for the future generations?
Do you want to try that, Bill?
Okay, tough question. So I think a lot depends on the particular composition of the council that you have and the senior leadership in the civil service in your municipality. A lot depends on the quality of the relationship between the civil servants and the council, and on things I'm not qualified to talk about, the political pressures that various council members face. I will say though, it is pretty clear to me that if the desire of council is to freeze taxes or to have below inflation tax increases, unless council is simultaneously reducing service levels, then essentially what you're doing is passing on costs to future generations. There isn't really any, I don't think the facts leave much room for doubt on that one. It's just the, politicians have to deal with the world as they find it and have to be elected, and so they have to be accountable to the residents that are their constituents in place at the time. So I don't pretend to understand all the pressures that politicians face, but right now, a lot of municipalities are passing costs on to future generations, and given what has been happening to the younger generation, someone said earlier, maybe it was Kelly, that there is a moral question here, which is it's a non-factual question. It's a moral judgment that councils are and politicians who are members of council are going to have to make about what they feel their obligation is to the current generation of baby boomers who are, as I showed in the slides, doing pretty well, and to the younger generation who at this time seem to be struggling. And there is a fair amount of literature out there that does suggest that the younger generation may have lower lifetime incomes than their parents' generations, and that will be a first in many, many generations. We've become accustomed to rising standards of living, and that may not be true for our kids.
I see it with my friends and people that are younger than me. It's a very difficult time, and they can't afford to buy homes, and they have no guarantees in job markets. So I can see how, and because they're renters, they're not actually represented sometimes in when we talk about tax increases. If 1/3 of your population are renters and those are the young people who can't afford to buy homes, then sometimes it doesn't equate into the argument in terms of how to best represent them as well. But thank you for
One-
your comments.
I would just offer one other suggestion. There's many in the room who will have more experience than I am, a first-time councillor. Good for you for running. You have a choice as a council about how much you set aside for your next election. One of the things that we're talking about, or we are doing in my municipality, is to invest a little more in election education. So our municipal clerk, for example, will work on getting a program into the schools. We can capture people who will be voting in 4 years who might not be vote ready now, because the biggest issue, of course, is that people over 80 years of age, I believe, have the highest voter participation rate, and the younger generation is not voting. So, and also in terms of the communications tools that you use in your municipality, some municipalities aren't using social media. There's different ways to connect with young people. So I too think it's an incredibly important issue. And the data that Bill gave us, coupled with the data about declining population, there was a slide yesterday at the Almer's presentation about the number of people working, supporting those pension earners, and it's quite a dramatic shrinkage of how much you will have on your backs to carry for the rest of us that have gone ahead. So it's a very serious issue.
But it also decreases the amount of time that those individuals can be involved in civic government because they're working 2 or 3 jobs and trying to put food on the table. So I think that plays into it as well. You might see a decline in those individuals voting because they're trying to make sure that they have a roof over their head, or they can pay their student loans, or
Keep on speaking up about the issue. Thank you.
I think Kelly wanted to.
I would also just say, Bill, well, Bill mentioned that your staff and politicians have to talk and have to start the conversation. You actually have to have the conversation with your voters, because you can't go and ask them to make a choice if all they understand is that the choice is your taxes are going to go up. Did you want your taxes to go up or down? The choice is really, do you want to burden your children further and grandchildren to keep your taxes down? So that conversation has to actually be held with the voters.
Okay, no more questions? I want to thank Bill and Kathy. As a token of appreciation, AMO is making a donation to the Disaster Relief Fund in their name. I also want to thank the AMO staff, Judy, who organized this session, and everybody else who makes it work for us, which is terrific. And you can now get coffee in the main foyer. You've got about 10 minutes before your next session. Thank you very much for your participation.